Hello and welcome to our daily show where we talk about personal and financial development. Today, we're talking about 2 ways to create a tax-free retirement. So, whatever that means to you, retirement, some people don't like that word retirement. They're never going to retire. Whatever it means for you. When you have financial freedom and you don't have to actively work and you get to pursue your passions, pursue whatever it is that you want to do when you're no longer working. You're eventually going to get to an age where you can no longer work. So you've got to have the resources, you've got to have the income, you've got to have the cash flow to be able to pay for your expenses and your life as long as you live. So we're going to talk about 2 ways to create a tax-free retirement. If you don't already know who we are, we're Martin and Chelsea Matthews. We're owners of M Wealth Group, a financial consultant and investment agency. We're also authors of this book, Let's Fight About Money, helping couples communicate about money, handle conflict, and build an unbreakable financial house. And that's really our mission, to help you build an unbreakable financial house so you can handle anything that comes your way financially and create the life and impact that you truly want to make. So today, as you're coming in, please let us know where you're tuning in from. If you like us, our content, any of the above or not, please like, comment, and share. Tag somebody if you know somebody that may want this information, because we want to help as many people as we can.
So first of all, here's why taxes are important. Number one, this is the debt clock. There's a bunch of numbers on the screen. If you look towards the top left, it says national debt. It says $30 trillion in debt that the government has, right? It's the fourth largest item in the budget. The interest on the debt. Interest on the debt is the fourth largest item in the budget. It's right behind the amount of money we spend on war and military defense and all that.
Government racked it up and they promptly handed it over to us.
Yes. And then on the right there, somewhere in the middle, it says tax revenue. So your tax revenue, let me zoom this in a little bit so you can see this better. So your tax revenue is $4 trillion the government receives, receiving for this year. But they're in $30 trillion of debt. What that means is, the amount of taxes they're bringing in is not sufficient to put a dent in the debt. It's not even sufficient to pay for 1 year. All the tax revenue they're going to collect this year is not sufficient to pay for 1 year of the government spending. The government has a 1.6 trillion deficit. A deficit is where you don't have enough money to pay your expenses. That's a deficit. It costs you X amount of dollars to run your life. You only have this much less than that. You're operating at a deficit. So the government's running at a deficit, which means they have to borrow money just to pay each year. Now, understand, if that's the case, and the only way you receive money, if you're the government, the way you receive money is by taxing your citizens, how else are you going to get revenue? Now think about it. You got to put yourself in the mindset of these people. They're promising you all this stuff that they don't have money to pay for. Even if all the taxes they collect, they don't have enough money to pay for all the things they're promising you, all the things they've already promised you. The second largest item in the budget is Social Security. They don't even have enough money for that. Yet they're promising you more stuff. Understand, it's just math. The math ain't mathing. So you got to understand, if the math ain't working, then how else are they going to get this extra money that they're promising people? Well, they're going to have to get it from you. They keep telling you, we're going to tax the rich people. Sure. How has that actually worked out? They still have a deficit. So you understand, when you're planning for your future, you got to consider an increase in taxes. And you got to look at, how do you control what you can? So that's what we're talking about, 2 ways to build a tax-free retirement, because they're coming after your retirement plans, by the way. Your traditional retirement plan, the reason they want you to put all this money in traditional retirement plans is because they're going to tax the crap out of it when you go to take your money out. And you will have no other options because you're like, I'm retired. I don't even have any income. I don't have deductions anymore. My kids are grown. My house may be paid off. I got zero ways to reduce this tax hit. And then you need the money. You can't be like, no, I'm not going to take the money because you're in retirement. You're going to need to take that money out. So we're going to talk about things you can do to make sure you don't have to pay taxes when it comes to your retirement income.
And then they can even force you to take the money out.
Yes.
If you try not to take the money out, once you reach, 70 and a half?
Yes.
You got to start taking that money out. So even if you're like, I'm not taking it out, I don't need to take it out. Well, guess what? You're going to have to take it out and pay the taxes.
So imagine that. Your own retirement, they're going to force you. The reason they force you to take it out when you reach a certain age for some of these plans is for the taxation. They want their money.
Well, it's not actually their money. They want your money.
And there used to be rules. Some of the tax rules are changing. I think they increased the age now to maybe 72 that you have to start taking it out. And there used to be ways that you could. It was called stretch. You could stretch it out, like if you inherited a traditional retirement plan from your parents or grandparents, you could take it out over a long period of time. Now they're closing that. They want you to take it out in a shorter period of time. Why? So they could tax you.
Mm-hmm.
They could tax you on it. It's the same thing happened with Chelsea's mom. She inherited a retirement account, and every year she has to take a certain amount out to comply with the law, and has to pay taxes on it. So,
and think about this too. Let's say your retirement account is not your only retirement account or your only source of cash flow when you retire. Let's say you have cash flowing real estate and you're like, I don't need to take this money out. I'm going to save it for my kids. I'm going to save it for my wife or husband or whoever, and I don't need that money. I'm going to save it and pass it on. But then you get to the age that they're like, no. You can't choose what you want to do with your money. You got to take it out and you got to pay us.
Yeah.
So we want to help you to understand what options that you have. We want to help increase your knowledge so that you know what is available. Because a lot of times when it comes to retirement, if you work for a company and you have a 401k, you may not know what else is out there. You may not know what options that you have, and you may not really even know exactly what you have. So we want to help sort some of those things out for you and let you know what things are out there that you can take advantage of and to actually create a tax-free retirement so that you don't have to pay all of this money to Uncle Sam. Mm-hmm. So there's two ways. We're going to talk about how to create a tax-free retirement. The first way is a Roth IRA. So when we're talking about retirement accounts, there's many different kinds. I mentioned 401k, that could be with your employer. Then when you leave your employer, you can roll it over into something called an IRA, an individual retirement account. You can also open one on your own. And those ones are not tax-free. Okay, when you have a 401k through your employer, that is tax deferred. You can put money in without having to pay taxes, but then it grows and grows and grows. And when you go to take it out, you got to pay the taxes. Same thing with an individual retirement account. So there's something called a Roth IRA, which is a Roth individual retirement account. And it basically means that you can put money in not before taxes. You got to pay money on the taxes on your income, but all the money that you put in and all the money that grows, then it grows tax-free. So when you take it out, you don't have to pay taxes. So if you think about, would you rather pay taxes on your income now when you know what the income rate is, or would you want to put all of your money into your retirement account, have it grow to a much bigger amount, hopefully, and then have to pay taxes on all of that money? A lot of people want to save money on taxes now, but if you look at, hey, do I want to have to pay taxes on way more money on who knows what rate in the future? When, like Martin said, when you go to retire, you don't have all these deductions and ways to lower your taxes. So a Roth IRA is one way to have a tax-free retirement account. Now, there's some restrictions on these types of accounts. So you can only put in $6,000 per year, up to if you make less than $144,000 if you're single, or less than $204,000 for a couple. So if you make more than $204,000 between you and your spouse, or $144,000 just you as a single person, can't have a Roth IRA. And if it's under that, you can only put in $6,000 per year. And in order to be able to take the money out, like when you go to retire, you have to have the account at least 6 years.
5 years.
Sorry, at least 5 years. And you have to be 59 and a half. So most retirement accounts, you have to be 59 and a half to avoid taxes for a Roth IRA and penalties. Like any retirement account, if you try to take it out before 59 and a half, not only are they going to tax you, they're going to penalize you and charge you extra because it's supposed to be for retirement. So those are some things. And then also, typically retirement accounts are invested in the market. So you're also subject to market risk depending on what you have what you're invested in. Now, if you have a traditional IRA or 401k that is taxable, you can convert it to a Roth IRA, but in order to do that, you have to pay taxes on what's in that account now in order to put it into the Roth IRA. Because remember, you have to pay taxes on the money before you put the money in. But then everything from then on growing in that Roth IRA will be tax-free.
Yeah, so a Roth IRA it grew in popularity. It's named after Senator William Roth, who proposed the bill because they wanted to have ways that people could have tax-free income in retirement. So the government put some restrictions on it, like, oh, you can only contribute this much, you got to be this age, you got to have it for these many years. All redundant stuff. Why don't you just let people have their accounts? Okay, fine, you fund it with after-tax money.
Control of their money, man.
Yeah. So the second way we're going to get into in a second, that would give you actually more flexibility than a Roth, because a lot of our clients, their incomes are higher than the contribution limit, so they can't contribute to a Roth because they've surpassed the income limit. But if you have a 401k or you have an IRA and you're concerned about market risk, market losses, you can always reach out to us and we can help you understand what level of risk you're taking. And one thing to understand is your 401k, your IRA, they are not investments. They are vehicles. They're investment vehicles. Just like I tell people to think of it like a shopping cart. Like when you say my 401k, your 401k has investments inside of them. So if you're going shopping, think of the shopping cart you're pushing at the grocery store as your 401k or your IRA. You choose what investments you're going to put inside of those, right? In certain IRAs, you can have real estate inside of IRA. They have to be set up specifically, done properly, and all that. But most people have stocks, bonds, mutual funds. There are some that you can have. Depending on which company you're using, you can have crypto inside of your retirement accounts. Fidelity is going to start allowing people to invest, have some Bitcoin inside of their 401ks, a certain portion of that. So there's different investment vehicles. And what there really are, they're named after the tax code. 401k is actually a tax code. It's Internal Revenue Code Section 401k. Internal Revenue Code Section 403B, Internal Revenue Code Section 457, Internal Revenue Code 529, that regulates college savings plans. All of these are tax codes, you understand? They're regulated by the government. So you have to understand when you're using these vehicles, it's not just something your employer provides for you. It's named after a tax code that regulates, defines what it is, what the rules are, how you can use it, how you can access it. It's all in the tax code. So then you can then go and look up the rules on Roth IRAs and understand, is this appropriate for me? Should I use it? Should I not use it? All of that. One way to know if it makes sense to go from a traditional IRA to a Roth IRA is the amount of money you have in there, because then you'd have to pay taxes on it. So if you have $100,000 in your traditional IRA and you want to go to a Roth IRA, that would basically count as income to you. It would add like an extra $100,000 to your income for that year, and you have to pay taxes on that in order to convert it to a Roth. So usually I tell people, look, if you've got $5,000, $10,000 in a traditional IRA and you're, I don't know, maybe 30 years old or something like that, yeah, maybe you add an extra $10,000 to your income, and it may not put you over into a new tax bracket depending on what your income is. And maybe it makes sense to convert it. Every case is different, so you can look at if it makes sense to convert your traditional IRA into a Roth so that you have your gains become tax-free when you're 59 and a half. All right.
All right, so number 2 way to create a tax-free retirement is actually life insurance. You can actually store money inside of life insurance and it can grow tax-free. And you can leverage it tax-free, which means you can borrow against it to use for retirement. And you can take it out, you can leverage it tax-free because loans are tax-free. Now, this is not just like your typical regular life insurance policy that only pays when you die. It's also, you're not leveraging the death benefit of the policy. You are putting money into the policy like you would for your retirement account. However, it's not invested. Well, the policies that we use are not invested in the market. And it has to be properly designed, it has to be properly structured, and it has to be properly funded. So you may have heard of cash value life insurance. You may have heard of bank on yourself. There's all different kinds of terms used for this type of policy, but not a lot of people, even insurance agents, not a lot of them know how to actually properly design these strategies. So it's very important to have it structured properly and also to be able to put the correct amount in for it to properly work and leverage for retirement.
Yeah. And so look, this is a specialty. And there are certain companies that you will use when you're trying to do a policy like this. And there are certain companies that specialize in doing it, and some companies don't. And the only way, so like, for example, a person will think, oh, I want to do a policy like that, so I'm going to call my insurance company. Well, your insurance company may have a terrible design for a policy like this because that may not be the specialty.
And when you say insurance company, some people may think of like, oh, car insurance or homeowners insurance. They're not all the same, and they don't all, like, if you see a commercial for car insurance or homeowners insurance, chances are they don't specialize in this type of product, this type of strategy.
And it might offer it to you just because your clients are like, oh yeah, let's make one and offer it to our existing clients. Doesn't mean that it's specialized in this. There's a handful of companies that specialize in these strategies as far as insurance companies go. So you want to also work with somebody who knows how to build and design these plans. To give you some perspective on how our clients use these, our average client they store inside of life insurance policies somewhere between $60,000 and $75,000 a year. We have clients who put in $250,000 a year, $400,000 a year. That's using these strategies. So understand, a lot of these people are high income earners, and so what they're doing is, instead of keeping all of their money sitting in a savings account or in a bank where they're earning very little interest, they put some of it inside of a life insurance policy that earns interest. So they get interest on a policy. They can then leverage it for income producing assets. They can then use it for retirement. Good morning, Josh. What's up? What's up, everybody? So they can leverage it for many different things. A lot of people use it for real estate. We have a lot of real estate investors for our clients. Some of them buy and sell multifamily properties. Some of them flip properties. They do this all across the country. And so they will store money inside of a policy and then turn around and take a loan against it. So a lot of people ask us, like, the complexities of these, how someone can borrow against it. The answer for so many of these questions is it depends. It depends on your plan design. It depends on how you're funding it. It depends on many, many different things. So for example, a person may have $100,000 sitting in their bank account. And by the way, there are way more people who have $100,000 sitting in a bank account than you might think. If you are in that position, you know that is true. Some people may not be aware that there's tons of people in that position. So the person may have 100,000, 200,000, 300,000 sitting in a bank account because they've shown they can accumulate money and store it. So they'll say, look, I've got 100 grand. I want to drop it. I want to put $100,000 a year into a policy like this. I want to take a $70,000 loan against it and go and flip this property, or be a private lender, lend to other people, invest it in businesses where I get cash flow, all of that. So the clients would do that. Other people are funding this on a monthly basis. They're like, okay, my cash flow doesn't allow me to put $100,000 a year away. So they're like, okay, I can put a few $100s, $1,000, $2,000, $3,000 a month away, and I can then let that accumulate, let that build up, and then leverage it in a couple of years, in a few years. Okay, so that would make sense. So there's a way to go about using these policies and have to be properly designed. There's one thing I try to explain to people over and over and over and over again. Your policy has to be properly designed. It has to be customized. You can't just, this is not like requesting a life insurance quote or a car insurance quote. This is, a policy is built and designed for your specific situation and your finances, right? There's some people who want to put in 100 grand a year, and we do that often. There's other people who want to put in 3 grand, 4 grand a month, and that's what they're doing. My recommendation, based on my experience, is that when you're ready to start using a strategy like this, if you're already saving at a minimum $500 a month, at a minimum. And I've seen lots of people say, yeah, you can put $100 a month away into a policy like this. Sure, maybe technically you can, but I wouldn't advise that. Look, $100 a month is $1,200 a year. How are you going to buy real estate with $1,200 a year? It's going to take you forever. So maybe you should take some of that money, maybe buy a term life insurance policy, and then work on increasing your income so that you can be in a position to where you can put $500, $1,000, $2,000 a month away. That's when you know you're ready for the strategy. We've been doing this for a long time. Chelsea and I have combined 22 years experience in the financial industry. We have clients in 48 states. Just over the years, and I look at our book of business and I surveyed our clients, the people who maximize these policies at a minimum are putting in at a minimum, and they're putting in way more than that. That's just a starting point, I think, for when a person knows. That means if you're saving $400 a month, and sometimes you save $300 and sometimes you save $400, I don't think financially that you're ready for this as a strategy yet. Maybe because every time I ask somebody, they'll tell me, yeah, I'm saving $300 a month. And I'll ask them, okay, how much do you have built up in reserves already? They're like, oh, I got 2 grand in reserves. All right, that means if you have a major emergency, you have to stop funding your plan because you don't have enough reserves. You've got less than 1 month of your expenses in reserves. So if somebody comes to me and said, look, I store 3 grand a month. I got $50,000 in reserves. Great. That person can easily fund a policy for years without it being a problem. So sometimes you don't have to jump to using certain strategies that you're not financially ready for yet. It's also one of the reasons why a lot of these strategies are not promoted to the masses, because a lot of these companies will go like, hey, a lot of these people are not financially able to, because when it comes to life insurance, and life insurance in this aspect is not just about your health. They look at your finances. They're like, can this person actually sustain paying for this deal? So they look at that. So something you got to understand when you're using life insurance for retirement is like funding it. Now there's flexibility. We build flexibility in there. So if you like lose your job, have a job change, have a slowdown in your business, all of that is flexibility we have in there where you can adjust how it's done. But I would highly encourage you to understand this as a vehicle. Hey, thanks, Greg Ellis. Greg's one of our clients.
Mm-hmm.
Why were you going to say that?
Yeah, I was waiting for you to take a breath.
Sorry, but you can say hello to Greg then.
Hey, Greg.
So anyway, these are customized, and you have to be. And here's one thing I will say to you. There are a lot of these plans are poorly designed. If your plan is poorly designed, it's not going to produce as much cash as it could. It's very, very important. And I see a lot of plans that are poorly designed. And it's something you have to understand when somebody shows you the numbers. We show people numbers behind these strategies that's customized to them. Matter of fact, why don't you give them the link where if they want to see some numbers around a strategy.
If somebody doesn't show you numbers in a strategy like this, That's not a good sign. You need to be able to see what your numbers are going to look like.
Yeah.
So if you are in a position to put at least $6,000 in a strategy like this per year, and you're saving at least $500 a month, then we can put an example together for you to see what your specific numbers would look like in a customized plan like this. If you're interested in seeing that and interested in looking at putting something like that in place, you can go to sixbuildingblocks.com/bank, sixbuildingblocks.com/bank, and you can request to have an example put together so you can see your customized numbers, what it would look like using a strategy like this and create a tax-free retirement.
Yeah, basically we look at, okay, what's your financial position? If you're putting this much away, here's what it'll look like in these number of years. Here's how you can use it. Here's how you can leverage it. We even have a network of let's say a lot of people want to get into real estate, but some of them don't want to go do it on their own. And we have a lot of clients who buy and sell real estate, and they're constantly looking for people who want to put money into their deal and do things like that. So we connect people in that situation because they're clients of ours. So that's some of the benefits that people get when they are our clients and they're using these strategies. There's lots of different things we help people with wills, trusts, estate plans, building out if somebody has a retirement account, they want to make sure they don't run out of money. All of those things are things you can do. You can actually turn your life insurance into your own personal pension plan. You can actually get income for the rest of your life through your life insurance policy. A lot of people aren't aware of that. I'm not talking about when somebody dies. I'm talking about a policy that you fund that grows, earns interest, and then you can get income for the rest of your life. You can turn on a feature called lifetime income inside of your life insurance policy. And because you can take them as withdrawals and you can take them as loans. So loans are not taxed, and your policy has a death benefit. So at some point, even if the policy goes and you take out a bunch of loans and you never pay them back, your death benefit will pay off the loan upon your death. So and send the rest of the money to your family if there's more left over. You can have multiple life insurance policies.
And there's no age requirements on like when you can take the money out or when you can leverage the money. It's not like a regular retirement account where you have to wait till 59 and a half. And it's not like a regular retirement account that you have to take money out at a certain age. Also, the strategies that we use are not in the market. So there's no risk of loss. You do not have ups and downs like you would in a typical retirement account.
Yeah, we have clients who will fund this with a lump sum and take a loan against it the next week. But that's if the client's generally putting a lump sum in there. So we'll have a client who will put in 60, 80 grand a year and take maybe a $60,000 loan against it right away to go put that towards real estate. So now they have the money staying in a policy, continuing to earn interest, and they got a $6,000 loan against that and use that inside of another deal that cash flows. So now they're giving their money two jobs. The money, instead of the money just sitting idle, money is earning interest inside of a life insurance policy, leverage that, then they put that into some other deal. Now they got money in two locations.
Clone that money, baby.
Yeah, they leverage the money and now they have money working in two locations. This is what rich people do. What is Elon Musk doing? He has Tesla stock. He's not going to sell Tesla stock unless he has to for certain tax purposes. But he has his Tesla shares, and then he borrows against it. He may or may not buy Twitter, who knows, but he's borrowing against it to buy Twitter. So now you see that he has his shares over here. He's going to keep building Tesla, and his shares keep earning, and he leverages that to go buy Twitter, which cash flows. See, so now he leveraged one asset to acquire a secondary asset. This is what rich people do all of the time. They do this all the time. Jay-Z, Beyonce, all these people have mortgages. What they do is they teach middle class that you should pay off your mortgage. Debt's bad. How come all the billionaires have debt? If debt's so bad, how come every single billionaire has debt? Your favorite billionaire has debt. Elon Musk borrowed against his shares of Tesla to buy a bunch of properties. At one point, Elon Musk was like $500 million in debt. You think he cares? No, this guy's the richest man on the planet. You think he cares about if he got $500 million worth of debt? He's not trying to be debt free. He's trying to build more assets. So I'm not saying go getting consumer debt. There's a difference. So when people leverage their policies, they're leveraging their policies to multiply their assets and multiply their holdings. And they have an immediate estate because if they die, there's a massive amount of life insurance that would pay out to their family. Tax free. It's in the tax code. So understand these are how these different tools and vehicles work. Like we said, if you want to see customized numbers for yourself, or you already are storing money, maybe you have a lump sum of money in your bank account and you're looking at, okay, I don't want to just keep it sitting there. I want to put it to work because inflation's high. You can go to 6buildingblocks.com/bank. You can also click on our link in bio and you can access that and we'll show you some customized numbers for your situation.
And if you're not quite ready for a strategy like that, send us a message and we have other resources for you as well that can help you get there.
Awesome. So we'll see you next time. We'll Monday through Friday, 9:30 a.m.